It is sadly the beginning of the end for many chains in America. For some, there is a little glimpse of hope of survival, but for some, it is the dead end. The financial crisis has swept through each of them and is likely to carry some away with it. Who stays and who goes then? Join us in this video as we explore 10 biggest chains in America that will disappear in the months to come due to the financial crisis. Big Lots. Big Lots, the discount chain, is making strategic changes to its store network. It is shutting down several stores in urban and suburban areas of California and Colorado, aiming to shift its focus toward small towns. The company plans to sell some of the closed store sites while others are being closed due to underperformance. CFO Jonathan Ramsden mentioned that the number of closures in 2022 was on par or slightly higher than the number of new store openings. Looking ahead to 2023, Big Lots intends to expand its presence in less populated regions of the U.S. Ramsden highlighted the advantages of operating in small towns, where competition is lower and operating costs are reduced, ultimately leading to greater profitability compared to stores in a major metropolitan area. The company believes that this shift in real estate strategy will strengthen its financial position. Best Buy. Best Buy, the popular electronics and appliance retailer, is also taking steps to cut costs and adapt to the growing trend of online sales. The company is making changes to its workforce, particularly in its specialized store positions. In April, hundreds of consultants who focused on selling complex products like computers and smartphones were informed that their jobs would be eliminated. These changes will affect Best Buy's over 900 stores across the United States. To streamline operations, the responsibilities currently handled by consultants will be consolidated into a smaller number of similar roles. Employees who are affected by these changes will have the opportunity to apply for other positions within the company or opt for severance packages. Best Buy has been gradually reducing store-level jobs over the past 2 years due to a decrease in demand for electronics and appliances, which can be attributed to shifting consumer buying habits and a decline in sales compared to the yearly pandemic period. This has included eliminating roles related to home entertainment layouts, shelf stocking, and sales floor assistants. The company also made significant job cuts in its Canadian locations. The decline in Best Buy's sales has been significant in recent quarters as the initial surge in demand for electronics and appliances during the pandemic waned. Shoppers have shifted their spending toward essential items like food due to rising inflation. Looking ahead, Best Buy CEO Ms. Berry expects continued volatility and predicts another challenging year for the consumer electronics industry due to macroeconomic headwinds. Walgreens. Walgreens, the well-known pharmacy chain, is facing some challenges in both the United States and the United Kingdom. With a decline in earnings compared to the previous year, the company is feeling the impact of reduced consumer spending and a decreased demand for COVID vaccines. To combat this, Walgreens is implementing various cost-cutting measures. CEO Rosalind Brewer announced an increase in cost-saving efforts aiming for a substantial $4.1 billion. In addition, CFO James Kehoe stated that the company will save $3.3 billion by the end of this year, with a projection of at least $800 million in savings for 2024. To achieve these goals, Walgreens plans to close 150 locations in the U.S. and 300 locations in the U.K. as part of its strategy to optimize profitability. To further streamline operations, Walgreens has eliminated over 500 positions, representing about 10% of its corporate and U.S. office support workforce. The company also plans to leverage technology to drive savings and improve efficiency. This includes the establishment of micro-fulfillment centers, the centralization of in-store activities through technology, and the implementation of telepharmacy solutions. While the specific store closures have not yet been disclosed, the spokesperson confirmed that the 150 U.S. locations will be shut down by the end of the next fiscal year, which concludes on August 31, 2024. Walgreens is committed to adapting its model to the changing landscape of healthcare with a vision for the pharmacy of the future. Bed Bath & Beyond. In a recent announcement, Bed Bath & Beyond revealed plans to close its remaining 350 stores along with approximately 120 buybuy BABY stores. These closures follow a significant decline in the brand's performance over the past few years. To aid in their recovery, the company strategically shut down hundreds of locations. To secure their financial stability, Bed Bath & Beyond implemented various strategies, including store closures. According to estimates, the company's assets and liabilities range between $1 billion and $10 billion. Their leadership had issued warnings about the possibility of bankruptcy in recent months, resulting in a decline in their share price. And in an effort to avoid this, the company raised around $300 million by selling shares in late March. The impact of their declining sales was evident, with some stores experiencing a 40 to 50% reduction in sales for the quarter ending on February 25th. Despite these challenges, Bed Bath & Beyond remains committed to serving their associates, customers, partners, and communities. They continue to work diligently to maximize value for all stakeholders, aiming to navigate this process successfully. Dollar General. Across the nation, Dollar General stores are facing a wave of closures stemming from persistent safety violations. This concerning situation began back in November 2022 when a Dollar General in Gretna, Virginia was forced to shut its doors due to customer complaints and fire marshal's findings. The store was plagued by overstocked merchandise obstructing the aisles, inadequate clearance between stock and ceiling, a malfunctioning heating system, and blocked electric panels. In December, another location in Mondovi, Wisconsin faced a similar fate after failing a follow-up fire safety inspection. The main concerns there were the compromised means of egress for customers and firefighters in case of an emergency. Sadly, the issues persisted, leading to the recent closure of 2 Dollar General stores in Watauga County, North Carolina. Fire Marshal Shane Garland discovered blocked exits and aisles in both the Vilas and Zionville locations. Altogether, at least 6 Dollar General stores have been temporarily shuttered due to safety violations over the past few months. Tuesday morning. In another sad turn of events, Tuesday morning, a well-established home goods retailer in the U.S. has recently announced its imminent closure. This comes as a second major blow to the industry, as another prominent retailer had also met a similar fate in recent days. Determined to bid farewell on a bittersweet note, Tuesday morning took to social media and its website to proclaim the commencement of a final sale. With discounts of 30% off, customers can seize the opportunity to purchase their favorite products from the remaining 200 stores until May 13th. Alas, the following weeks witnessed a gradual shuttering of these locations. The demise of this 49-year-old retail institution was precipitated by its second bankruptcy declaration within a mere 3 years. The company had previously embarked on a restructuring journey in February 2023, citing an overwhelming burden of debt. In a cruel twist of fate, Tuesday morning had also endured its first bankruptcy in May 2020 during the height of the pandemic. 4 store closures at the time had proven to be an insurmountable financial hurdle. Once boasting a staggering 700 stores across the nation, the retailer has now dwindled down to a mere 200 locations scattered across 25 states. Remarkably, Tuesday morning had never ventured into the realm of online sales, setting itself apart from its digital-savvy peers. The challenging economic landscape of the slowdown in consumer spending and rising interest rates has contributed to the growing number of financially distressed retailers succumbing to bankruptcy this year. Gap and Banana Republic. In an effort to adapt to the changing market conditions and boost online sales, Gap Inc., the parent of Gap, Banana Republic, Old Navy, and Athleta, has announced plans to close 50 to 55 Gap and Banana Republic stores across North America by the end of 2023. The company has been grappling with declining sales and profits worsened by the COVID-19 pandemic. To counter these challenges, Gap Inc. aims to shutter 350 non-strategic Gap and Banana Republic stores in North America by the end of the year, leaving around 870 stores open in the region. This strategic move, known as fleet transformation, is intended to meet the growing demand for online shopping. While a full list of store closures is yet to be released, some locations have already shut down or announced their plans to do so. These steps mark a significant shift for Gap Inc. as it seeks to navigate the evolving retail landscape and ensure its continued relevance in the face of online shopping dominance and changing consumer preferences. Walmart. In the first quarter of 2023, Walmart surprised everyone by surpassing growth expectations. However, amidst the success, the retail giant decided to close down some of its stores in various cities across the United States. As the largest employer globally, Walmart's decision to shutter certain stores may seem quite puzzling. While below-par financial performance was cited as the primary reason, there are underlying factors contributing to these closures. One significant factor is the saturation of stores in the market. During the pandemic, many store owners emerged resilient, capitalizing on consumers' eagerness to shop in person once again. Retail vacancy decreased and shopping center rents soared, leading to a surge in the number of brick-and-mortar competitors. This overcrowding in the market created intense competition for retail giants like Walmart, making it challenging to maintain strong sales figures. Although Walmart had been closing underperforming stores in recent years without providing specifics, this latest round of closures reflects their response to increased market saturation and the need to streamline operations for better financial performance. Despite their warning about a tough year ahead, Walmart's overall growth in the first quarter showed promising signs. Nevertheless, these store closures in major cities across the U.S. demonstrate their proactive approach to adapt and optimize their store network to ensure long-term success in a highly competitive retail landscape. Amazon Fresh and Amazon Go. Amazon recently announced plans to close several Amazon Fresh grocery and Amazon Go convenience stores as well as halt new store openings. This decision followed the company's announcement of 18,000 job cuts in specific areas of its business. The move raises concerns about the future of Amazon's grocery venture, which was expected to revolutionize the industry. Despite Amazon's attempts to enter the food and grocery market through various avenues like Amazon Fresh, the acquisition of Whole Foods, and the launch of Amazon Fresh supermarkets and cashierless Amazon Go stores, experts have labeled this venture as an expensive hobby that has yet to succeed. CEO Andy Jassy admitted that the company was experimenting with different store formats to stand out from competitors and attract customers. One of the challenges that Amazon faces is entering a highly competitive industry where established food retailers have honed their expertise over decades. While Amazon excels in e-commerce, traditional retail requires a different approach. It involves creating a captivating shopping experience that goes beyond mere transactions. Customers must be enticed to make purchases through the store's ambiance, product selection, and competitive pricing. Rite Aid. Rite Aid, the drugstore chain, finds itself trailing behind its rivals, Walgreens and CVS. In the race to win over customers with a staggering debt of nearly $3 billion at the beginning of the year and an estimated annual loss surpassing $200 million, Rite Aid is grappling with significant challenges. In an effort to alleviate their financial woes, the company had initially planned to close approximately 145 stores, capitalizing on the resulting savings and increased prescription volume to improve cash flow and settle their debts. However, Rite Aid's financial struggles are compounded by the interest on their debt. A notable 50% of the chain's debt carries floating interest rates, which means that whenever the Federal Reserve Board decides to raise rates, the cost of borrowing money escalates, further impacting their bottom line. This makes it even more difficult for Rite Aid to regain its footing and overcome the competitive advantage enjoyed by Walgreens and CVS. The situation Rite Aid finds itself in is a daunting uphill battle where they must confront fierce rivals, surmount their massive debt burden, and navigate the precarious fluctuations in interest rates. With how things are going in the U.S. retail market, only time will tell survives this stormy wave. Meanwhile, what do you have to say about this topic? Let's hear your thoughts down in the comment section below.